Good morning, everybody. I'm Jim Atkinson, Hidden Paradise Realty Team at UTR Texas Realtors. My number is 281-798-7163. You'll find all that information in the video as well. I've also got Mike here with me.
Hi, good morning, everybody. Mike Lupia with Highlands Mortgage. You can reach me at 346-763-6174.
And we'll have your email in the comments as well, so everybody will have that. Today we just want to talk about, maybe the state of the market and all. We're nearing the end of January, so the holidays are all up and over with. We do have, I know in February we got Valentine's Day coming up, so we don't forget about that. But in the real estate industry, we don't really consider that much of a holiday unless you're going to buy your sweetheart a new house, maybe get a sweetheart deal in February also. But we did want to talk about, a lot of people are still kind of holding off on the market. They're waiting for interest rates to drop down. They're waiting for the market to crash. And some of those things that you might be waiting for may not happen. So let's kind of talk about best strategies right now. Mike, what are you seeing in the market? I know that as a realtor, I'm getting an increase in people asking about looking at houses, calling me that have been on the fence. What are you seeing in mortgage applications, things like that?
Yeah, no, definitely a big uptick. Compared this time of year to last year, I would say we're up about 40% year over year. Definitely a lot more activity of folks getting pre-approved. To start that journey of shopping for a home and looking to close before the spring. So yeah, definitely things are off to a quick start this year.
Yeah, and we still, just another thing to remember is, even though we had that slowdown in the market over the holidays, so we have some inventory that's been sitting for, 90 days. Anybody that was looking for houses last year, probably starting in March, April, May, you notice houses sat on the market maybe for a few minutes, a few hours, a few days, and you might think 90 days, wow, it's been on the market a long time. Well, anyone that's been seasoned and been out there, or even anyone that's been looking for a while or who hasn't looked in a while, that's not going to seem all that abnormal to you. It's still a seller's market. It's not as strong of a seller's market as it was, but even with prices having gone up, with interest rates being a little higher, things to think about if you're waiting for that to happen. Maybe don't wait, because things that you can do right now is work with your realtor, work with your lender, talk about rates, talk about possibilities. Refi is always possible, after a couple of years or so.
That's right. If
you're seeing those rates go down. But, if you're waiting for that to happen to get the best deal, you may get a worse deal, because even when interest rates last year were in that 2, 3, 4% range, so definitely lower than it is right now, housing prices were a lot higher. So, it kind of balanced out in a lot of aspects. And while those housing prices have stayed up, taxes have stayed up. So maybe you can't buy as much due to that interest rate in your debt to income ratio. You might be able to get a better deal on a house because it's been sitting a little longer. We have a lot more sellers that have listings and that have sat for over 90 days, mainly due to the holidays. Don't think there's something wrong with the house because it sat too long. But you're going to see some of those opportunities. So work with your lenders, get your pre-approvals, have your lenders, talking with your people now. The importance of a good pre-approval. Let's talk about that.
Oh yeah, well, absolutely. So a pre-approval obviously is where your lender, by either your qualified loan officer or the actual underwriter, will review your income, your assets, your credit profile. And make sure that your purchase plans fit within all those guidelines, so that when you make your offer on a home that it's approvable, that it's all going to fit with it in the box that's needed to get you into that home. A pre-approval is one of the most vital tools you'll have at the start of the home buying journey. Now, that is different from a pre-qualification. A pre-qualification is 9 times out of 10 not worth the paper it's printed on. It's kind of like when you get the offer in the mail, hey, you're pre-approved for a credit card, and oh, that's very, very exciting, but how do you know? It's just a cursory review of your credit score is this, you make that, sure, you qualify for this home. So always speak to your lender about a pre-approval, because it's going to show the seller of the home, it's going to show your realtor that you've got skin in the game, and that you're truly a motivated and prepared and ready to go buyer. So.
Yeah, another important aspect, both with your loan officer as well as with your realtor, is to tell them the truth. Tell them everything that's going on. They're on your side, and they're there to help you. And if you don't tell them everything that's going on, no, we don't need to know the drama happening with the family. But, in the financial aspect of things, what's going on with your situation, be upfront and honest with them, because it's going to come out eventually.
Absolutely.
And it's better to have that up front so that you're not disappointed, a few weeks in, or after you get an offer put in and you find out, you can't do this because, of situations that are out there. So just be upfront and honest. with the loan officer as well as with your realtor so that they can best help you out.
Yeah. And I would say to that point, especially in regards to your income, if you're a W-2, just straight W-2, be it salary or hourly employee, by all means, when you're filling out your application, you put the income that you make. If you've got anything outside of that box, you work in the gig economy, you might do Uber or DoorDash, or you might be a contractor that you do a lot of jobs for this company, but they pay you on a 1099 basis, disclose that. Let your loan officer know, because that's a whole different income calculation. And some people will come into the picture thinking that they make $80,000 a year, but in reality, they make $50,000 a year when you factor in the income qualification. So always good to paint that picture up front and know exactly what you're working with in that regard.
You know, keep in mind also, a lot of times we think we make this amount of money. And I hear this not just from Mike, but from a lot of different lenders that we work with, you know, in our industry. Sometimes people think they make a certain amount of money. They think they receive child support. They think they receive this income because they physically do. But when it comes down to it, you know, there's so many aspects that have to be in place and proper, because remember, most of these loans, they're government-backed loans, and the government has lending guidelines when it comes down to that, and they're going to need to see these qualifications. So, for example, if you're receiving child support, it's very important that you've received it, what, for 6 months?
6 months typically.
Yeah, typically 6 months, and that you have a divorce decree and everything stating you receive that.
Right.
It can't just be handed under the table, just like, you know, income can't either.
Right.
So if you're self-employed, if you're a W-2 employee, you know, we're at tax season time, so make sure those taxes get filed. Make sure they're filed timely and regular, because believe it or not, you have to have your taxes filed in order to purchase a home, because they have to verify all that with the IRS and all, right?
Absolutely. And if your loan officer is certified and they know what they're doing, they will be able to advise you on the spot. So as long as you're painting the true picture to them. Case in point, customer may work, you know, their main job at Target, and then may also work part-time, you know, at Subway, you know, on the weekends. Well, that part-time income, if it hasn't been in place for 2 years, it's unusable, because it's just that, it's part-time, there's no stability. So you want to make sure that you get all that information to your loan officer so they can review it and say, okay, Mr. Customer, you know what, this all looks great, we're able to use both incomes, we are good to go. Or, hey, we can't use this portion of your income, but let's see what we can help you purchase with this portion. So you want to make sure that you have all the knowledge, but then also all the tools in the toolbox to get you into the home that you're looking to buy.
Well, and let's talk about something else that's very important in the industry. From time to time, I'll be working with a client, and maybe they've talked to someone, you know, that's not someone that I'm familiar with in the lending world or something. A lot of times your realtor will have preferred lenders they work with, and it's because they have a relationship with them. They know what the lender's going to do and what they're not going to do. It's not like we're receiving kickbacks or anything. That's illegal in our industry. We must disclose any of those relationships or anything else, but they're there to guide you and to try and get you to work with professionals that they're familiar with. They know their styles. They know that they're going to give you a good qualification letter, or they're going to let people know, you know, what's going on with it. So that's really important, to have great communication between your loan officer and your realtor and you as the client, so that we're all on the same page, because at the end of the day, we want to get you into a house, and that's what you want to do as well. But we want to get you into a house that you can afford, that when we submit an offer, it's going to be something that will work for you. Because at the end of the day, also, we don't want you to be disappointed in finding out later that, no, you can't do that because you can't be approved for this loan, or, you know, whatever. Other times I'll hear people say, well, I talked to so-and-so and they just gave me a pre-approval, and they told me my rate will be 5.25%. Well, honestly, any loan officer can tell you that, but until you have a house and you're under contract and you've done what's called locking your rate, I think it's a proper term, right?
It is, absolutely.
So once you get an offer on a house and everything, your rate's based on what it is that day. You want to talk about that briefly?
Absolutely. In fact, that's a very, very good point. Harkening back to what you were saying about folks waiting and seeing what the market does. So last year, as I'm sure everybody went through with inflation, the Federal Reserve, to tamp down inflation, was raising their benchmark rate. And they were raising it 0.75% every single month, and that happened for 7 months in a row. Now, typically that doesn't have an immediate impact on the mortgage market, but with the economy being in the shape that it was in last year, it did. It did actually have an immediate impact. So folks were getting pre-approved at a 4% rate out there shopping, and they found a home 60 days later, well, come to find out that 4% is now pushing 6%. Well, hold on, that changes the entire landscape. So now your monthly payment's higher, it changes your debt to income ratio. There were quite a few folks who thought they were approved and ready to go that all of a sudden couldn't afford that home. So what's going on right now? Now that we're in 2023, back in December, the Federal Reserve slowed down the rate of increases that they're doing. So rather than going 75% of a point each month, they've now slowed it down to 50 because we're starting to see the inflation cool off, but it's not quite there yet. They have said that they're going to do this at least 3 more times. So they're going to increase their benchmark rate 0.5% or more each month for at least 3 more months and then kind of revisit it. Me personally, I think that's pretty much how things are going to play out. Hopefully we'll have inflation under control by then. Yeah. But going back to the wait and see folks, there are a good number of clients that I've dealt with that are playing the wait and see game because they're hoping that rates are going to fall back down to that 2%, 3% range. I will tell you this, 20 years in the lending industry, we are not going to see 2 or 3% rates for a long, long time, and it's going to be something, to make that happen, something catastrophic in the economy would have to happen. The ruling consensus is rates are going to level off in the 5s, 5 to 5.5, maybe the high 4s, which obviously compared to a 2% rate is awful, but in the grand scheme of things, that's really a decent rate because rates were kind of held artificially low for years and years and years. So don't let a 4 or 5% rate or even a 5.5 scare you. That's really a great rate, and then you always do have the option down the line, if rates ever do drop below that point, to refinance into a lower interest rate, or you might even want to refinance into a shorter term loan. Take your 30, turn it into a 10, make accelerated payments or turn it into a 15 and get out that much quicker. But again, your qualified certified loan officer would be able to answer those questions and run those numbers for you. So.
Yeah, and the main thing too, I mean, it's great because Mike knows his stuff. He's keeping his pulse on the market and what's going on, and any great loan officer should be doing that for you. But the main thing we want to talk about too is just make sure that when you're talking to different lenders and they say, hey, I can get you this rate. Well, no lender can guarantee your rate unless they're locking it in that day. Right. So unless they're locking it in, it doesn't matter what they tell you. Don't go, wow, I'm going to go with this lender because they can get me this rate. Well, they don't know because they can't predict the market unless they're, again, locking it that day. And that is a thing that does happen. You pay for that benefit. Not all lenders will do that. And right now, it's not a good thing. When the market was kind of shifting and trending towards up, when I'm talking about the market shifting, I'm talking about the interest rates. It was good for some people to go ahead and lock in a rate because they could lock in that 4.5 and then shop for about 6 months. I had a few people that did that, and it was very advantageous for them. But 4, 5, 6%, those are normal. Anyone that I've talked to that wasn't in the market last year, I've asked them, hey, do you know what the rates are when they're a few people reached out to me in November and December thinking about making a move, and I said, well, are you aware of what the rates are? And when I told them what they were, they're like, oh, okay, because they didn't understand or they didn't experience the 2 and 3% rates because that was an anomaly. It was a big anomaly.
Big anomaly. And for those lock-up fronts, they're sometimes called buyer readies. There's cute little names for each lender, for each bank. You also want to look at a cost savings perspective. A lender that I know would charge 3% to do that. We're going to lock your rate for 6 months, but we're going to charge you 3% of your purchase price. So that's $6,000 on a $200,000 home. Well, let's say you lock your rate at a 4, and then when you go to actually submit your contract in, you found your home, and the average rate is 4.5%. Well, you've spent $6,000 to guarantee a savings of $15 a month. So how many times of 15, what is that, 400 payments to, you're basically going to be in the home for perpetuity to recoup that savings. So again, those are conversations that you would want to have with not only with your lender, with your loan officer, but also with your realtor. Look at, what your price range is, what the appreciation typically would be for that home. Is it going to pay for itself in the long run? It's great to have that protection, but again, make sure it works for you. Make sure it works for your scenario so you're not throwing good money after bad.
So let's talk about, while we're talking interest rates and everything, the advantage or disadvantage to buying down your rate, because we hear a lot of that going on. You can buy it down to 5 or whatever. And I hear a lot, and I'm going to leave this to you because I'm obviously not the mortgage professional. I'm the realtor. So I hope you find that house once we get you approved. But, everything else needs to be redirected back to a qualified lender. So when it comes to buying down your rate and you're going to spend that money, I hear you need to be in there for a certain amount of time to where that's beneficial. Do you want to talk on that briefly?
Yeah, absolutely. Again, it falls back to cost savings. How long is it going to take you to recoup that cost? So if I'm locking my rate today, let's say today the market has my rate at 5%, and I have my eye on that awesome 4%, and on this particular scenario, and I'm just throwing round numbers out there, that's going to save me about $50 a month. Okay, so we'll say it's costing me $2,000, $50 a month. So what is that? That's 40 payments where I'm going to recoup that investment. That $50 savings is going to pay for the $2,000 cost to purchase that down. All right, so that's 40 months of being in the home. So if I plan on being there 3.5 years or more, it's paid for itself.
So 3.5 years is your break-even point.
Correct.
So if you're not going to be there for 5-7 years, you may not see a lot of savings off of that. Plus, in the next 3.5 years, what if rates were to go down and you refinance? There is a cost to refinance, but you have to look at all that all the way around. Don't just go, wow, I can save 0.5% or $50 a month.
Right.
If you're gonna, not be there as long, and in average, if you're someone who is buying your first home, your second home, or if you've been in your home for a while and you're getting ready to downsize, that could make sense, because if you're downsizing, you're probably going to be in that home. That might be the last home you're thinking of buying, or your forever home. If you're a first-time home buyer or second-time buyer, you're probably going to purchase another home. And we see on average, 3, 5, 7 years that people are in their home before they're ready to make a move. Right. So, if you were there 3 years, well, you actually just lost money.
Exactly.
So you have to really watch at that and look at all those scenarios all the way around. Listen to your realtors, listen to your lenders. Hopefully the people that you're hiring to help you out are the experts in the industry and giving you the good advice. Sometimes, a family member or somebody might have been a realtor at one point, or a loan officer at one point. If they're giving you advice that's conflicting with it, tell your loan officer, tell your realtor, so that they can help and see and help you see and understand what today's market's doing, because it's totally different than it was. I've been in the industry only 9 years, and a lot has changed in those 9 years. It's insane how fast our market moves, our prices, our property values. Very and true. The advice that I would give a client today is different than the advice I would have given a client 7 years ago.
Yeah. Ultimately, the interest rate just calculates the payment that you have. Some people equate an interest rate, a lower interest rate especially, as to being something flashy. It's kind of like, do I want to buy, the Kia, or do I want to buy the Porsche? They're both cars. They're both going to get you to where you need to go. Which one serves your purpose better? So, in this instance, on that scenario, the Kia, the higher rate is going to serve you better, because, you're not wasting money. You're going beyond or going less than the break point. But in that same scenario, if that was a forever home, you plan literally on staying there 10 years or more, all day long, it's worth the cost. And that's what it ultimately comes down to. You want to make sure that any money you spend pertaining to obtaining the mortgage is good money. It's not, junk fees. It's not, throwing bad money out the window. Same thing with your down payment. Does it make sense to do a lower down payment, or would it make more sense to put more money up right now to do a 20% down payment, or even a 15% down payment to avoid the mortgage insurance? There's different calculations that go into play there that we custom build to your scenario to make sure that it's going to benefit you short term and long term. My personal motto is, you never want to be house rich and cash poor. So.
Yeah, I absolutely agree with you there. And, with that, it's a lot of information all at once. I want to just remind y'all, if you have questions, if you have concerns, if you're not sure if you're ready now or not, reach out to your realtor, reach out to your loan officer. Absolutely, I'd love it to be me and Mike. But if we're not the ones in your lives that are guiding you in that, or if you're in a different area of the state even, or the country, you can still call me. I can help you find an agent. Mike can do loans in a couple of states, as well as help find you qualified loan officers in some of those other areas also. So be Lafayette, state of Texas, Houston area, any of that, give us a call definitely. Again, my number is 281-798-7163, and you can reach Mike at
346-763-6174. And just to pony up with what Jim said, remember that your lender, your loan officer, they work for you. So you should be able to and be willing to and ready to ask them questions and make sure that they're giving you the information that you need. So.
All right. Well, with that, that's a wrap.
Sure.
And y'all have a great rest of your day, week, night, evening, morning, whatever time you're watching this.